Welcome back. Episode 3. We're managing to keep it consistent, Sam.
Yeah, doing good.
Yeah, good. We promised last episode to move on to, I believe, an under-talked area in markets in general, and again, just trying to make topics that educate and give insight to how we're using credit. Probably with a focus on corporate credit in our portfolios. So I think, again, sort of just like we did on the last episode on US equities, if you could just give a little bit more simpler context to what we mean in simple terms when we're talking about corporate credit. What are we what are we talking about before we get into some of the more technical elements of it?
Yeah, so at a very top level, these are debt instruments that are issued not by sovereign entities, so sovereigns being governments, etc., or you might get supranationals. So that's your, European Union, believe it or not, actually issue some debt rather than individual governments. So these are your BP, Shell, Apple, those kind of companies, but could go anything all the way down to kind of like Joe Blogs down around the corner, strictly speaking, is a form of corporate debt.
Yeah.
But it would be called credit because it's not publicly tradable. That's the difference, really.
Okay. And do its return characteristics therefore replicate like a loan someone might make to their friend, or is it a bit more complex than that? How does a loan, how does this credit instrument either produce a positive or negative return for your portfolios?
Yeah, so the return that you receive is legally defined in the contract. So as our viewers may not have taken out debt instruments themselves, obviously what you pay is written down in the contract. So based on certain situations coming, what you should receive back for holding that. Obviously there's default risk, and we might touch onto that a little bit later on. But yeah, so rather than with equities, your returns are limitless, but your losses might be capped at obviously 100%. With debt instruments, you're very much defined by contracts what you will return.
But a fund manager's job is also to be buying and selling those like a stock at either a good entry point and a bad entry point as well. Could you? That was more what I was trying to drill down to, that they're a bit more complicated than just a straight loan note, for example.
Yeah, so on the public markets, things very rarely trade at, what we would call par. So basically, in theory, if you issue £100,000 worth of debt, very rarely on the public markets will it be trading for £100,000. So it will either be traded at a premium, so above that par value, or trade to a discount. Now, there's various reasons why things move up or down. One of those is through basically interest rate variable movements. So credit yields, so that's the interest rate that you receive based on how much you have paid for the debt.
Yep.
As opposed to a coupon rate, which we'll touch in a second. It's comprised of two elements. There's the risk-free element, which would be determined to be similar duration sovereign debt of that currency. Mm-hmm. So say it's a 7-year BP instrument, you'd look at the equivalent 7-year UK government gilt for that interest rate element, and then you'd add on the credit risk element over above that, and that's what we call the spread. Okay. So that's those two things and how they change. So as things go up in yield, conversely, the price has to come down of ready issued instruments, so that figure can happen. It can't just go up through no. There has to be something on the equation that allows it to equal out.
Okay, and yeah, as with all markets, the wider credit space is massive, and you've sort of have touched on there how that could be corporate credit as well as government credit. So, with the aim of keeping today's episode reined in a bit to corporate credit, I just go back to an advisor meeting we had a a couple of weeks ago as I think the basis for my next question to you. I think it was a man fund where you were again given advisors great insight to, as portfolio managers should do, the winners that they've picked in the previous year. And I think it was a man fund that you flagged as having significant, not just strong return, but outperformance. So again, like I did in the last episode, if you can refresh back to what fund that was, and again give a bit of an insight to a particular fund we hold and what that outperformance was and why, and whether you still hold it. So yeah, that's
sure.
your next 5 minutes.
So the fund you're referring to is Man Sterling Corporate Bond.
Okay.
So that's run by Man Group, and the fund manager for that is Jonathan Golan.
Okay.
And Jonathan came across to Man Group, I think, coming close to 3 years ago now, and it flagged up onto our research screens at the end of 2023, and then obviously went through our due diligence, and we quite liked the fund because at that point it was a smaller fund but run really well, and these two things are really, really good within this space because it gave it a USP, which is because it's smaller, it could afford itself to look at the smaller issuers within the market. So not necessarily the people who in one go issue, for lack of rounding and picking a number out of there, issuing $1 billion of debt at one time. Yeah. That'd be a very big amount, but for rounding up, this concentrated on more the issuances that a lot of the bigger funds wouldn't bother spending their time with initially at issuance. So for people that issued saying 50 million at one time or 30 million. And what that means is that they having a unique advantage. They were able to find pockets of value before anyone else was. They weren't concentrating on the big plays. And what that meant is that as they took these at primary issuance, so they didn't go out and buy them, from someone else selling the instrument on the market. They took these instruments literally from the companies who were issuing them.
Okay.
So there's a little bit of a discount that happens there as well. But as other companies going, look, we're trying to find extra value within our portfolios, where do we find them? They start digging further into the smaller issuances. Yeah. These things were starting to flag up, and therefore the holdings were starting to come up in capital value, and that was really, really good. And last year we're looking at 3.7% of outperformance, which doesn't seem huge in itself, but the thing is to bear in mind,
that's pretty good.
I was going to say, you take it, but the 3.7% outperformance, this is now our biggest fund in the lower portfolios. Sterling Corporate Bond is the biggest sector within the lower risk portfolios. And once we got more confidence with Jonathan's strategy, we moved more away from passive, which I'm not a huge fan of passive funds anyway within fixed income, because there's so much potential for information dissymmetry to be able to utilize
the opposite to the US.
Yeah, they're complete opposite to the US. But 3.7% on our largest holding does give us quite an advantage. And 2024, I think it was north of 10% was the outperformance versus benchmark. I think the benchmark was slightly down on the year, and I think Jonathan produced around 10%. I think from top of my mind, it was a very good performance.
Yeah. And what were a couple of the core bond holdings of that fund, bringing it back again to?
Yeah, sure. So within that, there was some of the Eastern European banks. I can't quite remember right off the top of my head. Yeah. I think one was a Romanian bank that it was at that point a triple B, but had all the characteristics of something more investment grade. And so, that certainly rated up an awful lot over the year. Yeah. So that helped an awful lot. But where Jonathan's also been working quite well is thinking not just on that stock picking element. I know it's bonds, but we still stay instrument picking should be the better term to use, but more looking at the macro. So concentrating on instruments that aren't sensitive to interest rate changes. So the modified duration. So as a result, concentrating on things that are perhaps a little bit shorter in term remaining, but also, maybe a little bit further up into the credit risk space of that kind of sphere. But it worked well because the longer end of interest rates, despite Bank of England rates coming down, the longer end, so more your 10, 30 years, those have actually been going up, the interest rates, over the last 18 months or so. Yeah. So that's, I think, it's been a real win for him.
Yeah. And again, just for future weeks, and please put some thoughts in the various comment sections of the platforms that we're distributed on. But just to give you context, all these insights from Sam, there's 35 different master benchmark sector allocations. So when managing multi-asset, it's having information and snippets and having the right people to lean on in all of these different areas. So again, we've done US equities and corporate credit. If there's areas that you want us to speak about, please do let us know, or clients watching any particular sectors we don't speak about much. Please let us know for future episodes. So sorry, that's a slight breakaway from the theme, but yeah, keep bringing it back to this corporate credit space. I'll be honest, I thought you were going to talk about Mike Scott, so to not give him a complex in speaking about one of his colleagues versus Mike Scott, who we've been working with many years. Could you could we give an overview of some of the Mike Scott driven funds that we've held in the portfolios for the last 5-10 years, why they've been good holds, and how they fit so well in this corporate credit space for you and the team?
Yeah, so historically, Mike is very much a
hi Mike, if you're listening.
Might have to get Mike onto here actually, because he's a great mind to pick. So we've held Mike's high yield OIC now for, well, it's longer than I've been.
OIC being an open-ended investment company.
Yeah.
Yep.
So in the UK, that'd be your ordinary fund that you would see on platforms.
Standard fund holding.
Yeah. So Mike has been, in our portfolios for longer than I've actually been managing on them. So circa at least 5 years, I think, pre-COVID even. The reason why I've always really liked my discussions with Mike is Mike isn't always really bullish on his sector. And I really value a manager who can tell you, doesn't just give you the salesy answer. So Mike will tell me when high yield is, I think circa 2 years ago, he was saying about, look, the easy money in the high yield space, that's come and gone. It's now really about that stock picking and that kind of area. And sure enough, Mike has been outperforming, continuing to outperform as Mike does. We held an awful lot of the high yield opportunities actually in 2022 when interest rates were going up, and that really protected the lower down portfolios an awful lot for those interest rate hikes.
And when we held no high yield at one point last year, that was actually Mike's idea, though, not your idea. I'm joking.
It's kind of true.
Great insight, yeah.
No, but it's kind of true
so well
because,
as well, so.
Because the reason why, although it sounds weird, Mike's insights kind of got us to sell down that fund.
Yeah.
But equally, we've conversely bought another one of Mike's funds off the back of it, which is, I always get the words the wrong way around. So sorry, Colette, our BDM, if I get this wrong. It's Man Credit Alternative Opportunities. I think.
Okay.
Sorry.
No, it's just saying. Okay.
No, yeah. So what this is although it centers very much in the high yield space, it's a long short fund. So it doesn't just go out and buy.
Quick explanation of long short for the viewers, please.
Yeah, sure. So going long on something is to own something, and to short something is in essence to sell something that you don't own. So it's kind of like to
benefit when the price goes down.
Yeah, you benefit when the price goes down in essence. And there's various ways you can do that at a more technical level, but at top level, that's where that is. So we hold Mike in this space. So why do we do that? That's because we don't see with where, going back to what I was saying earlier, the spread. So basically, the interest rate you're paying for, credit risk is at the moment is incredibly tight. We're talking like all-time lows. So it's not really a space that we necessarily see there's value there. So that's why we're holding Mike's long short fund. So it uses insights that he evidently has to be able to pick the idiosyncratic areas where he thinks things are overvalued, or conversely, are fairly valued, to help smooth out the journey, but still collect a return in the meantime.
So one area, to make the FCA not think we're on an endorsement schedule with GLG, is an area just to again move on to, which is emerging market debt. So perhaps if you could just give a brief insight of what falls into emerging market debt, and give us an outlook and any role it's playing in the portfolio at the minute.
Yeah, so it's an area that actually we're really keen on for this year. So first thing is probably to define what emerging markets are. So obviously it's what isn't a developed market. So developed market would be your Western Europe, North America, Japan, and Australia, New Zealand, kind of thrown in there. Within emerging markets, obviously, conversely, you have EMEA, which covers Eastern Europe, Middle East, Africa. You have LATAM, so Latin America, within the Asia space. So you've got India, China, all of like
captures that BRICS sort of.
Yeah, the BRICS kind of bucket, but also you might be surprised to hear that it also contains Taiwan, which actually is in a lot of ways has a lot of really good companies. Well, emerging markets generally does have a lot of really good companies, but you have some of the real big AI people are there. So in terms of size, they're massive. Reasons why we're quite happy about emerging markets for 2026. So this year, as we've seen already over the last 2 weeks with the yen intervention, with the dollar selling off an awful lot, what was expected for this year is a bit of a weak dollar environment. And that tends to be something that really helps emerging markets, economies power through really, really well. Mm-hmm. So we've been concentrating an awful lot on the domestic space in that area, in terms of domestic fund managers that target the domestic economies, including in Vietnam, etc. But we've got two plays that we do now. One of which is the Vontobel fund, Vontobel Emerging Market Blend, off the top of my mind. But also we've got
sounds like a wine.
It does. I'm about to fly out to Cape Town, so I'm going to continue my emerging market research very, very well at the moment. But also we hold the PIMCO GIS emerging market bonds. So because it's an area where it really, really helps to have really good active managers, because there's so many companies. Obviously, you're talking about a huge space here. You definitely don't want to be passive, just because of, if you're passive, you hold every company, and that means that you don't just hold the good ones, you also hold all the bad ones. But emerging markets, reasons to be positive going at sovereign rather than a corporate level, but obviously the corporate gets put on over the top of that. So the foundation is that an awful lot of emerging markets these days are actually, from a debt perspective, run really prudently. Debt to GDP levels far less than Western economies, and so but yet they're trading that at a discount. So why wouldn't you pick up the extra element there, particularly when you're looking at emerging market economies could possibly do really, really well this year? It seems like a double win.
Okay. And just because I keep making you talk about fund specifics, which I think's really useful for listeners, is I think too many podcasts and things just talking about the world and things. There's lots of sources, so I think the fund insights are particularly helpful. However, I'm conscious we haven't spoke to anything macro in the space. So I think probably my last sort of area for discussion in today's episode is just discussing more the macro backdrop for corporate credit, or if you want to talk debt in general, to again try and round this episode off. That would be great.
Sure. So I think it's bifurcated. So I think you very much need to talk about developed world and emerging markets separate. Emerging markets, obviously, we just spoke about. There's still a spread that can compress there, and not just that. We're talking about economies that rather prudently run these days, which, from a fixed income, so the debt perspective, is all magic words you want to hear. When we look into the Western world space, obviously we've got the high debt to GDP levels, which is the bedrock which all the corporate space is put onto, but the spreads are all-time lows. And so if you were to hold something over a medium term, it doesn't look like a great space. So that's why we're starting to play far more the alternatives, the long shorts, these kind of elements, so that we add a bit more stability into the portfolios. It also helps with the volatility of the whole portfolio, which is nice. But I think from a more medium term, the current credit spreads aren't sustainable over a medium term. Okay. So we might be a little bit early to the party, but I'd rather be a little bit early to the party and our thesis still works than be late to the party and have clients on the phone to me asking, why is my portfolio down 20%?
Okay. All right. And we've already dropped quite a few names into this episode, but as a running theme for what we think our target audience is, but as I say, we're adding listeners every week, going based off the numbers. Again, if we could just probably recap on some of the stuff that you've spoken about for how advisors should be talking about this corporate credit space at the minute, probably with a bias to your own holdings and things there. But again, if we could just round each episode off with that sort of what and how advisors should be talking about this space. Yeah,
so don't assume just because yields are obviously, compared to not far off the last 20 years, are very much raised up. That means that credit is attractive, particularly on the long end of the credit curve. So when I say long end, I mean things that have more got like over 15 years, 10 plus years to run. Going to be looking at those yields possibly still going further, off of worries as to particularly the US fiscal position,
which would be negative for bonds.
Yeah, exactly. Okay. And if we're looking at, if that goes badly wrong, then that will increase risks everywhere. The yields are where they are, as I said, because spreads are compressed. So you could end up with a situation where that spread increases further, selling off on a corporate perspective compared to sovereigns, but the sovereigns are still selling off as well on those tail ends. So very much don't want to concentrate on that end. And as a result, you want an active manager who do that fundamental work for you. And not just that, if things move around quickly, they can move around quicker than we can. That is really, really important. At this point, where the spreads are, an index passive fund to me just simply does not make sense. I think that's what I would take.
All right. And just again, recap on your current corporate credit holdings.
Yeah, sure. So it's Man's. I'm gonna jumble them up. So the Vontobel Emerging Market Blend Fund.
Yeah.
The PIMCO GIS Emerging Markets Bond, I think it is. The Man Credit Opportunities Alternative, and our biggest holding, by the fact that the sector is so large for a UK RFA perspective, is Man Sterling Corporate Bond.
Okay. And that's the one we hold the most in.
Yeah.
Yeah. Which you spoke very positively of at the start. And we'll hopefully continue to hold it and have another successful 2026 in that fund. So yeah, I think, again, don't want to make these too long, as I keep saying. So hopefully that's been again, an insightful insight to the world of corporate credit, and we made it as interesting or bearable as we could. But again, these sessions are designed for education, insight, which I think we've got again there. So yeah, thank you again, Sam, for your time. Enjoy your trip away, and yeah, we'll look at themes for the coming week's episodes, and keep these going. So yeah, thanks.
Thank you.
Great, thank you. Cheers, guys. Bye.